so much. Good morning, everyone, and welcome to our webinar today on implementing ASU 2016-14 not-for-profit financial statements. I am Patricia Pryor. I am one of the leaders in our firm's higher education and not-for-profit practice. With me today is my awesome co-instructor, Karen Walker. Karen, take a minute and introduce yourself, please.
Thanks, Patricia. I'm Karen Walker. I'm a Director of Assurance Services, and I work out of the Charlotte and Gastonia office of Cherry Bekaert. I work primarily with our not-for-profit and higher education industry group. So to kick the webinar off, I'd like to share the course objectives with you. Participants today will have a good understanding of the goals and objectives of ASU 2016-14. You'll be able to identify the key reporting differences that we need to consider in implementing the ASU, and you'll be able to develop an effective implementation plan for your organization and identify areas where you may need help. Now, as far as the effective date, it's here. It's effective for fiscal years beginning after December 15th, 2017. So for your December year ends, it is required to be implemented for your December 2018 statements. For June year ends, it's required to be implemented in your June 30, 2019 financial statements. So these very next statements that you will be drafting will need to be updated for requirements in the new ASU. One thing to remember, in the year the update is first applied, we're required to apply the changes on a retrospective basis. However, if we present comparative financial statements, we can choose not to present the prior year information for expenses by nature and function, and also the liquidity and availability disclosure. So before we go any further, we have a polling question. So the question is, what type of not-for-profit entity do you represent? And your options are going to be educational institution, are you a church or other religious organization, are you a cultural artistic organization, a social services organization, or other? So, Chrissy, do you have our results? Okay, it looks like the results, approximately 48% of you are with educational institutions. With the next largest group in other. So we have a lot of varied participants out there. So thank you. Thank you for joining us today. So Patricia, what are the primary objectives of ASU 2016-14?
Well, some of the primary objectives of the standard was to eliminate some of the perceived complexities in presenting net assets, to improve financial statement and footnote disclosures. And really what the FASB was trying to do was to help not-for-profits better tell their story and to ensure that the financial statements were clear, uniform, and comparable across not-for-profits. So basically just trying to make the financial statements a little bit clearer and to also provide donors and lenders with liquidity information to better assess the health of the not-for-profit. Just as a point here, this standard is not by any stretch of the imagination a complete overhaul of not-for-profit financial statements. It is basically just an update. And when you go back, the last time there was any major update to not-for-profit financial statements was in the early 1990s when you were required to adopt FASB 116 and 117. So it was just an opportunity to refresh not-for-profit financial statements. Next, we're going to talk about, before we get into some of the lessons learned, we're going to talk about the main provisions of the standard. There are 5 main provisions. One, reporting net asset classes. The second is liquidity and availability disclosures that will now be required. Some enhancements in some existing footnote disclosures. Some specifics about presenting expenses by both natural and functional classes. And then there were some minor tweaks to the statement of cash flow. So with that, let's go to the first main provision, the change in net asset classes. Currently, not-for-profits are required to present their net assets in 3 classes: unrestricted, temporary restricted, and permanently restricted. As you can see, under the new standard, that will go down to 2 net asset classes: without donor restrictions and with donor restrictions. I know a lot of people are saying, well, why was this change necessary? Well, first of all, there was a general feeling that by combining permanently restricted and temporary restricted, that would reduce some of the complexity in not-for-profit financial statements. There was also a general feeling that over time, the lines between temporary restricted and permanently restricted seemed to get blurred. I think one example of that was now, it is considered prudent to spend from a restricted endowment, even when the fair value of that endowment is below the corpus. So they felt eliminating some of those would help the financial statements to be more understandable. And I think finally, there was some general thoughts that, maybe the face of the statements of financial position and the face of the statement of activities was not necessarily the best place to put detailed information about the nature and types of donor-imposed restrictions, and that would probably be better served to be in the footnotes to the financial statements. While you can see that unrestricted is now going to be called without donor restrictions, there was no change in the definition of what an unrestricted net asset is or what a net asset is without donor restrictions. That definition has not changed. Basically, it is the same definition. It's net assets that don't have donor restrictions. But they did feel that even with the word unrestricted, there was still some lack of clarity as to what unrestricted really meant. Now let's look at an example of a statement of financial position after the change. If you see the financial statements, you'll see, if you go to the bottom, you'll see the only change is really at the bottom where we're showing net assets with and without donor restrictions. Just wanted to make a point. The standard is not changing the option that you currently have to present board designated amounts that are without donor restrictions. So if you're a not-for-profit and you generally would have presented like a board designated operating reserve, board designated endowments, you can still delineate those items on the face of the statement of financial position under without donor restrictions. So the standard has not changed that at all. The one thing we have seen in the early adopters of the standard and what we see within our firm is that one of the line items that's generally under without donor restrictions is to present property and equipment, net of depreciation and net of related debt. So that is one of the things we're seeing consistently that not-for-profits that are early adopted did include. The one thing we want to point out there is, though, if you are a not-for-profit, historically your without donor restricted or your unrestricted may have been positive, but may have been positive because it was primarily made up of property and equipment. So when you do that, we may see that not-for-profits are showing deficits in their without donor restriction category that you would not have seen before. So that's just one thing to point out there. So let's look at an example of a statement of activities after the adoption of the standard. And you can see your two columns. You've gone from the 3-column presentation to a 2-column presentation, with the first column being without donor restriction and the second being with donor restriction. We have seen in some of the early adopters, if you happen to be a not-for-profit organization that did not have net assets with donor restrictions, and you've typically presented in one column, that would continue. All right, so let's move on to the next big area of the standard, liquidity and availability of resources. All right, this brings us to our next polling question. And Christy, the question we're asking here is, does your organization have a liquidity policy? Yes or no? Give everybody about 30 seconds to put in their results. Christy, do we have the results? Okay. It looks like the majority of folks do not have a liquidity policy. All right, well, we'll go ahead and shut that polling question down and go to liquidity and availability. By far, most of the folks who've looked at the standard feel like this is one of the bigger areas where there is a change. Currently in not-for-profit GAAP, there is no requirement to disclose information about liquidity and the availability of resources to cover obligations of the not-for-profit. There's always, however, been a general requirement that we are required to present assets and liabilities in order of liquidity in the statement of financial position. And one of the suggestions we actually have here for as you adopt the standard, is to take a look at your statement of financial position, and if you feel that those assets and liabilities are not presented in order of liquidity, to consider making those changes. So what is meant by liquidity and availability? Liquidity generally relates to the type of asset that an organization has and the maturity of that asset to meet current obligations. Current obligations as defined by the standard are basically obligations that will be coming in the next year or 12 months. Availability. Availability is it available for use? Are there donor imposed or other external restrictions that could limit the availability of resources? Are some of them self-imposed limitations placed on the organizations by the board? So what is the standard change? Going forward, not-for-profits will now be required to disclose in the footnotes to their financial statements how they manage their liquidity and availability of resources to meet the cash needs by being able to fund general expenditures within 1 year of the statement of financial position date. So the disclosure actually has two parts to it. There's a qualitative component and a quantitative component. So let's move on and let's take a look at what one of those looks like. Okay, wait a minute, before I go there, let's talk a little bit about liquidity. This is one of the questions that's come up in the early implementers. What should be included in that footnote? Generally, cash is restricted, investments, accounts receivable, pretty much your liquid assets. You should generally exclude from that disclosure things like fixed assets, prepaid inventory, or any asset that is illiquid. One of the things that we started looking at when the standard first came out is that, at first we thought we would see a lot of negative disclosures in this footnote, but really it's really not focused on net assets, it is focused on assets. And so theoretically, most not-for-profits, this may not be a negative number. You do not include any liabilities in this computation and when you're doing this disclosure. So that's just one thing to be aware. And when we go through one of the examples, I'll point out a few things that we've learned in the process. So just be mindful that it's assets, it is not net assets. So here is an example of the quantitative disclosure in words. And so here you can see this not-for-profit is disclosing its financial assets, and it's basically going through and saying that it's comprised of cash of $75,000, contributions, and short-term investments, and that none of these financial assets are subject to donor or any other contractual restriction and are available to fund general expenditures with 1 year from the statement of financial position date. It also discusses some implied time restrictions in contributions receivable, and basically stating that the amounts that are included for that amount are expected to be collected. So this is one example of how to present it if you want to use words. The next example is how to do that in more of a table format. And here's an example of how to do that in a table format. And you can see basically listing the assets. One of the things we want to point out here is that this is only one example of this liquidity and availability footnote. First of all, this presentation is really a net presentation. If you pay attention to a few things, like if you go down to the third line, it says operating investments. So in this example, if you had endowment investments, you would not include it. And if you look further down, you will see distributions that are expected from assets held under split interest agreements and distributions expected from beneficial interest in assets held by others. So this is one example. The other way we've seen this presented is more of a gross presentation. So for example, we've seen examples where you would list cash, accounts receivable, total investments, and if those items include endowment investments, you would show those as subtraction. If you use the gross investment kind of disclosure, and let's say you have a board designated endowment, you would show that as a reduction to come up with that net number. So just be mindful that there are two examples that are out there. One is a net presentation and one is a gross presentation. So let's move on to the next part of what is required. Here is the qualitative part of the disclosure. And in this part of the disclosure, you are basically discussing what the organization's policy is about how it meets its obligations, if there's excess cash that's not needed for operations, that it's invested. It also discusses in times when cash is not available or other assets are not available to be liquidated to fund expenditures. The organization has a line of credit that it can access to handle any unanticipated liquidity needs. So just wanted to point that out and just step back for a second and remember that the qualitative part of the disclosure that's required, I would say, is all about the words and really speaks to liquidity. The quantitative part or the numbers part is really trying to present what is available, what available resources are available to fund expenditures. You know, in the polling question, we asked how many of you have a liquidity policy. Just wanted to point out that the standard does not require you to adopt a liquidity policy. It simply states that you have to disclose whatever that liquidity policy is. So that is one of the areas as you implement the standard that you may want to look into, whether or not you want to implement a liquidity policy or not. And even if you choose not to go down that path, you know, whatever you'd want to disclose in here, is this something that you would want to discuss with your finance committee or your board so they know what's going to be presented? So now let's go to some of the other enhanced disclosures that Karen's going to go through with you.
So with the removal of the distinction between temporarily and permanently restricted net assets on the face of your statements, the statement of financial position and your statement of activities, we're required to disclose information about the restrictions imposed by donors on the use of the assets they've contributed, including their potential effects on specific assets and liabilities or classes of net assets, because it's helpful in assessing the financial flexibility of your organization. So, for example, this is an example of a new net assets with donor restrictions disclosures. It specifically breaks out the restrictions by type. Your first group at the top of the schedule is those net assets with a purpose restriction, formerly known as some of your temporarily restricted net assets. Then the second group, as you move down the listing, includes the net assets that are only restricted due to a time restriction, also aka known as temporarily restricted net assets. And then the third group are primarily your endowments. In addition to these three major categories, you may also have net assets related to term endowments that would be in their own category. And there are also a couple other examples on this slide for different categories for you to consider. Things like life insurance or real estate required to be used as a specific purpose. Just different little tweaks in endowments. Now, board designations refer to those net assets without donor restrictions that have been designated by the governing board for specific purposes. We're now required to disclose descriptions of the purposes and amounts of those board designations. And like Patricia spoke about earlier, you can actually do that on the face of your statement of financial position, or it can be disclosed in the notes. Here is a quick little example where you can disclose your governing board designations. And actually, I think I actually saw this detail disclosed in the liquidity disclosure earlier, so there are a number of places where you can add this disclosure. So there are a couple of changes to our endowment disclosures. We are no longer required to show the components of investment income in the endowment note. All of the components are to be combined into one investment return line, and I've got a good example of that here on the next slide. So in this example, you can see the second line is investment return net. This includes everything from interest income, realized and unrealized gains and losses, and investment fees. In the past, we would show the detail and then subtotal it, and it was an additional item that drew your attention to the detail of the investment return. So I'd like to share with you the intent behind showing this summarized investment return. The intent of this update, and frankly of MIFA, is that endowment management and spending shouldn't focus on the difference between what is realized and what's not, but it needs to focus on total return and a long-term plan to support those endowments. We've actually encountered in the early adopters some clients have wanted to include the detail of the investment return in their statements so the reader can see the difference between actual investment income and unrealized gains. However, we believe the writers of MIFA and the ASU want readers to report investment return net, which is what the law allows and expects boards to manage by. So in a side note, though, CB encourages you to at least use the net asset presentation on the face of your statement of activities and in this endowment disclosure. But if you need to see the detail, you can include the detail of the components of investment return in your investment note disclosure. So, an additional change, if a donor-restricted endowment fund is underwater, we no longer account for that as unrestricted net assets. The accumulated losses are now to be included together with the fund and net assets with donor restrictions. Additional disclosures required related to the endowments that are underwater are if you have underwater endowments, which is the fair value is below the original gift value, you have to disclose these three things. You have to disclose the fair value of the endowment fund. You have to disclose the original gift value, and then you also have to disclose the underwater amount. We wish you all the good fortune to not have any underwater endowments. So, in addition to the disclosures that we've already talked about, the standard requires additional policy disclosures. These are specifically related to your endowment, but policies that you should be disclosing are interpretation of the law, any actions taken during the period, any changes in your assumptions, the appropriation of endowment assets for expenditure, and your interpretation of the ability to spend from underwater endowments. Also, along the lines of disclosures, the new ASU specifies how to treat the release from restrictions of long-lived assets. If a donor gives money to an organization to construct a building and puts no other restrictions on the funds, those funds are restricted, but they're considered released from restriction when the building is placed in service. Some not-for-profits have followed the policy that if a person gave money for the construction of a building, the actual release is released over the life of the building. So as it's depreciated, they were releasing it from restriction. But that is now clarified by this standard that the release should happen when the building is placed in service. So next up, the ASU requires changes to how we report expenses. Before ASU 2016-14, only voluntary health and welfare organizations were required to present expenses by both function category and natural category. But now, all not-for-profits are required to report expenses by both of these categories and in one location. This is an example of how we've seen a lot of organizations report this information. You've got your functions across the top of the schedule, so you can see your program activities. This organization had 3 program activities, A, B, and C, and you'd write out what they were, instructional, scholarships, and so on and so forth. And then you have your supporting activities with management in general and fundraising. So that's across the top, and then going down the left-hand side, you'll see your natural categories of expenses, your salaries, grants, supplies, and so on and so forth. One thing I would like to share with you, keep in mind that your policy note disclosures to your financial statements need to include a qualitative description of the methods used to allocate costs among program and support functions. For instance, some organizations allocate depreciation to the different functional expenses based on square footage of space used by the departments supporting those functions. Another example would be salaries. They may be allocated to different functions based on time studies. So there's going to be different ways that you're going to find that you probably allocate expenses across these line items. And now's a good time to analyze those and revisit them. So Also, with your expenses, we have three options for where we present this information. You can present it on the face of the statement of activities, or as a schedule in the note disclosures, or as a separate financial statement that would just fall in line behind your statement of activities. This leads us to a polling question. Our polling question is, where would you prefer to report your expenses by both functional and natural categories? And remember, you have to have it all on one schedule. So where would you like to report it? Would you report it on the face of the statement of activities? Would you set up a whole separate statement of functional expenses? Or would you go ahead and show it as a note disclosure in your notes to the financial statements? Okay, let's go ahead and close the poll. It looks like the majority of you agree with my preference. I think as a statement of functional expense, it just has so much information to present. So I think it would be pretty clearly presented there. Now, some of you did say on the face of the statement of activities, I can see that this would be beneficial too if you didn't have a lot of different categories of these expenses, because your statement of activities could get really long if you tried to put a really long list in there. And also, I've seen it in the note disclosures, and it works there too. So you've got options, and it's always good to have options, right? So moving on, since we're talking about expenses, investment expenses are now required to be netted against investment income in the financial statements. Since they are net against investment income, they are excluded from your functional expense schedule. And so in talking about these, your investment expenses may include external expenses such as broker fees, management fees, etc., or they can be considered what we call direct internal expenses. Now, direct internal investment expenses involve the direct conduct of investing or the direct supervision of the strategic activities involved in generating the investment return. Now, one thing that it doesn't include, though, are things like the accounting for the investments, the costs associated with unitization, and other such aspects of endowment management would not be allocated.
Hey, Karen, I'd like to make a point here, and one of the clarifications on that too, the direct internal expenses, be mindful that this is intended for organizations where, let's say, you do not have an investment manager, you don't have a firm that manages your investments, so it's trying to put you on an equivalent basis. So if there is someone or folks in your organization that are responsible for the direct supervision of the strategic and tactical management of your investment portfolio, then you can allocate those costs to investment returns. But be mindful, just think about it in this way. If you have an external investment manager, you're paying fees. If you don't have it, but someone is actually performing those duties, then that would be included. But it is not intended and other accounting people are reviewing investment performance. It's really think about it as someone internal is doing your investment management.
Thanks, Patricia. So moving on from expenses, our next big category are cash flow changes, and honestly, the changes to the cash flow statement are fairly minimal. Primarily, you're allowed to present your cash flow statement either on the direct method or on the indirect method. But one thing to remember, if you use the direct method, you're no longer required to present cash flows provided by operating activities using the indirect method of reporting. In the past, we've been required to add this to kind of reconcile to the first part of your direct method cash flow statement. So one thing we don't have to do. So finally, let's implement ASU 2016-14. And we have a poll. Our poll question was, or is, what has your organization done to get ready for the implementation of ASU 2016-14? One of your options is very little. Did you say it has to be implemented soon? Your second option is we're in good shape and making great progress. Your third option is implementation is 99% complete. I'm just listening to this webinar to ensure I haven't missed anything. Well, it looks like most of us have voted. Chrissy, can you shut down the poll? So it looks like we are in great shape. The majority of you are making progress in an implementation plan, most likely, and thinking about how this ASU is going to affect your financial statements. 38% of you are in the same bucket as a lot of other people. We're in the same place. It's been a busy year and haven't had a lot of time to think about it. And then the 4% of you that say you're 99% complete, that's great. Okay, so moving on. So as we discussed earlier, the time to implement the standard is upon us all. Now that we've had a refresher of the major changes in the standard, we've compiled these key items that will assist you in your ASU 2016-14 implementation plan. We believe the first step of an implementation plan would be to consider your accounting policies. Now is the time to approve any policies that you may need to adopt this standard. It's a good practice to have approved policies in place. They can really help us all to ensure that we're all on the same page. Some policies to consider may be one for liquidity. Your endowment accounting, you should have a policy of whether your policy includes spending from underwater funds. You should also have a policy of your functional expenses and how you're allocating between those functions. And I'm sure you can probably think of several other policies that would help. You also have some options with the ASU. It's good to know those options. We've talked about your options in presenting your expenses by natural category. We've talked about the liquidity disclosure. It could look very different between two organizations. So you have options, and it's good to know those. And it's good to get the buy-in of everybody that has an interest in your financial statement. Also, with the adoption of this ASU, we think organizations have the opportunity to refresh their financial statements. You may have options with some of your older note disclosures that you'd like to update, or even, I know some of the folks that I've worked with, they've inherited an endowment, and there was one or two pieces of the endowment that had been bothering them for years, and they had suspicions that some of the funds may have been treated incorrectly. Well, now is the time to research it. Now is a good time to look at your financials and really refresh them. With our implementation plan, we also need to educate. Hopefully your auditors have done a good job of educating your accounting or your audit committees as to the standards that were coming up and how they may change your financial statements. But you may need to do some education too and further explain some of the changes. And finally, when you're ready to implement, we think a great place to start is with your prior year financial statements. If you're able to mock up the prior year financial statements for the changes required, you'll have a good idea of what you'll need to consider for your 2018 statements when the ASU is actually required to be implemented. In addition, you'll be a step ahead for 2018. If you want to present comparative statements, you'll have to show your statement of financial position and statement of activities in the new format for your prior year. One thing that we talked about earlier, just as a reminder, if or when you do show comparative financial statements, the liquidity disclosure and the functional and natural expense categories don't have to be shared comparatively.
Karen, let me jump in here for a second. The one thing that we have seen with some of the early adopters, we've not seen anyone make the liquidity and availability resources footnote comparative, but for some organizations, they have decided to include the statement of functional expenses if they're doing it as a separate statement for both years, because let's say they already had the information available. For example, we had one client that was already presenting that information to their finance committee, so felt, instead of just putting 1 year in, they would just put 2 years in. So that's something that's an option. It's not a preclusion, and we have seen it in some limited cases.
Thanks, Patricia. So next up, we have some lessons learned, and we're going to turn it over to Patricia for this part.
Thank you, Karen. So we've tried to summarize some of the things that we've learned from some of the early adopters that we hope that you will find helpful. First of all, don't underestimate your reporting time. And this is from both an internal perspective and an external perspective. From the external perspective, your auditors, some firms have different policies around when a new standard is adopted, if there's additional reviews that are needed for their quality control process. So please think about that. Also, one of the things that we've seen is that presenting the reports in the new format has required additional time in audit committee and finance committee presentations, so they can see what the changes are. So don't forget that it probably will take a little bit more time, and you may even have additional time within your normal internal finance staff reviews. So don't forget about that. On the liquidity footnote, as I spoke to earlier, in general, we would expect that footnote, if you use the tabular form, to end up with a positive number, but wanted you to be mindful that if you are a not-for-profit, for example, that has borrowed from endowments, that number may not be positive. It may be a negative number. If there are situations where formerly temporary restricted dollars are now with donor restricted dollars may have been used to fund operations temporarily before you have satisfied the donor restriction, that footnote could be negative. So that's just something to think about. On the board designation side, we encourage everyone to make sure they're having conversations with their board about board designations. In some of our early adopters, we've seen situations where the board has decided to make changes to those designations. It was also a good opportunity for management to present what the board designations have been in the past and what the composition is and how those designated balances are being computed, to allow your board to make any adjustments that they may feel are needed. For example, there may be some different thoughts about, how to calculate your operating reserves and certain things like that. There may have been balances that were previously board designated that your current board may say, we don't feel that's necessary. So use that as an opportunity to review that. Because remember, when you present it, if you present it on the statement of financial position, if you don't use words, if you just said board designated, you're going to have to define some of that in your footnotes, or if your descriptors are very clear, then you may or may not need to put any additional footnote disclosure. The other area is in the functional expense disclosures. Just as a point, if you decide to use, even regardless of how you decide to option you decide to use, but one of the things we've kind of taken this in two pieces. One, it's an opportunity for you to look at what your major programs are. The standard does not say you have to list every program that your not-for-profit is involved in. It states the major ones. And in some of the early adopters, we've seen where maybe previously you may have had, if you were presenting on a functional basis on the statement of financial position, and you may have had 10 or 12 programs, but when you looked at what they were, they really kind of fit into 2 or 3. So take it as an opportunity to look and see if you're presenting too many categories or not enough. And I think the thing to remember here is to remember why the standard is being implemented, is to add clarity to not-for-profit financials and to help tell your story. So think about that as you're coming up with your major programs that you'll be disclosing in columns or in different ways when you adopt the standard. The other area we've been seeing some things that in the functional expense category is look at what your policies are and what things are being allocated and how you've allocated. This may be a good opportunity for you to look at some of your allocation methodologies to see if they still make sense, if you think they're still presenting what the current trends are in your organization. For example, there may have been, some allocations where maybe you were allocating some salaries, 20% to program, 80% to management in general. Well, when you look at what those individuals are doing, maybe they're doing more programmatic work, and maybe the allocation needs to be a little bit different. Also, one of the differences here is that, if a not-for-profit had prepared a statement of functional expense statement before, or even sometimes if it was in the footnotes, the audit requirements for those statements or that additional disclosure may have been what I would call audit light. If you had presented a statement of functional expenses as a supplemental schedule, you would notice that in your opinion, it says your opinion is an in relation opinion, and there was limited procedures done over that statement. So your auditors may need to look at some of your the major allocations that you're doing to make sure they understand, and maybe do some additional testing. So that's something to be conscientious about. Another area we're seeing some things is in the endowment area. For example, if you have had permanently restricted endowments in the past, then you're used to doing your endowment footnote. We've seen differences in how that is handled. The endowment footnotes sometimes would be pure endowments. Sometimes it will be endowments plus other perpetual gifts. So do you want those other perpetual gifts to be in your endowment footnote? Well, one of the things that that Karen went through was a sample of your new footnote on net assets with donor restrictions. One of the options that's in there now is for you to present endowment and perpetual gifts. And you can show those as separate line items. In all of our early implementers so far, we have seen a lot of organizations that had non-endowed gifts remove them from the endowment footnote and put them in the net asset with restriction footnote so you don't lose that information, and put it under a category, for example, something that says, perpetual net assets that are not subject to appropriation in the spending policy. So that's something to think about. One of the other things that we've seen in some of the early adopters is we found several situations where if you had endowments where the earnings were to be used for unrestricted or operating purposes, in some cases, those net assets had been presented historically in unrestricted, not in temporary restricted as they should have been. Because one of the implied things with endowments is that whether or not the earnings are restricted or not restricted, there's an implied time restriction because those accumulated gains are not subject to use until appropriated by the organization. So that is one of the areas that you need to look at to make sure that any unappropriated accumulated gains on endowments where you can use those funds for operations, that those stay in with donor restrictions. Also, some other thoughts about, look at the training of your staff. Do you feel like, beyond the CFO and the controller, are your staff accountants aware of the change that's coming in? And making sure that they understand the changes and the different vernacular that will be used going forward. One of the things that we found, and we've been surprised by this, is even once the financial statements are drafted, doing a really good read of those financial statements. Some of us have been surprised. We've gone to the end and we still find words like unrestricted and temporary restricted still embedded in certain footnotes that were not as apparent that we needed to clean out. So that's one of the things to think about. And I think the biggest thing, and Karen spoke to this a little bit already, is really I'm encouraging my clients to take this as an opportunity to look at areas in your financials where you could do some refreshing. Is a disclosure still needed? Are we explaining things appropriately? And all of the early adoptions I have gone through, we have found areas where we could, I would call it modernize, get out some disclosures that maybe were important years ago that we're finding that maybe they're not as important. There are supplemental schedules that were included in reports that now, with some of the enhanced disclosures around things like your net assets with donor restrictions, that you may not need some of those supplemental schedules. So just use it as an opportunity to refresh your financial statements. And I think the final thing is, making sure if you have any processes in-house that need to be modified so you can track the information that you need to present your financials now and with all the new presentation standards, that your systems allow you to do that. We've been answering questions as they've come through, and I think at this point we are at the end. Karen, are there any other lessons you feel like you've learned that outside the ones I've shared that may be valuable since we have a few minutes?
There were a couple that I had made a short list here of. One thing, when you were talking about liquidity, I learned a lesson, but when I was working with an organization with the early implementation, we were taking the financial assets available for spending, and we were reducing it by net assets with donor restrictions, thinking that represented the non-liquid assets, which it did represent the non-liquid assets, but it also included liabilities that reduced those assets. So in most cases, we're not reporting any liabilities in the liquidity schedule because they are usually considered to be general obligations of the organization in the upcoming year. So it's not necessarily as simple as taking your available assets less restricted net assets. You really need to consider what the asset value is restricted, and it usually is more than what your net assets are because those are reduced by liabilities. So that was one learning event for myself. As far as expenses, I know I tried to do an expense schedule that was probably oversimplified, and I had natural categories of salaries, benefits, maybe supplies, and a few others, and a really large miscellaneous number. But really, a good rule of thumb, the detail needs to be provided for any natural category that exceeds. A rule of thumb would be maybe 5 to 10% of total expenses. So that the schedule is really valuable to the readers of your financial statements. To have a really large miscellaneous expense number really probably will just lead to questions. So go ahead and break that down a little bit further if you can. And then finally, yes, in reading financial statements, those words popped up everywhere: unrestricted, temporarily restricted. You'd be surprised at how many times you'll see them. So just be on the lookout for those and switch them out with net assets with donor restrictions and without donor restrictions. And that's about it, I think.
Thank you, Karen. And I want to emphasize one of the suggestions that Karen made with the functional expense. I think we did see that quite a bit. We saw some folks that put together a statement of functional expense that turned out to be 2 or 3 pages long. That's too much. Just think about, making sure that you delineate those natural items, but do them in a way that it doesn't become an overwhelming sort of presentation. Well, that's all we have for you all today. We thank you all so much for joining. Karen, if you could flip the slide deck so that they can see our contact information. If you all have any questions, you're going through something and you feel like you need some help, please do not hesitate to reach out to Karen and myself. We are here and available, and you all have a great day.
Thank you.
Bye-bye.
Thank you all so much for joining us today. If you would like to download the handouts before we end the webinar, you can do that under the Handouts tab. Just expand that tab and click on the file to download it. If you answered 3 or more polling questions during today's presentation, you will receive a CPE certificate via the email that you registered with in about 3 to 4 weeks. Thank you all again and hope you have a great day.